Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about the latest trade figures that have been released for June 2024. Now, at face value, these figures actually look quite good. Exports are up by more than 8%, which is the best result that China has had for more than 15 months. So you would expect that I'm going to be telling you all about how great China is doing. However, as we've discussed many times before, you always need to look into the detail to see exactly what's driving that movement in exports. And what you'll find from today's video is that there's been a lot of things happening with regards to the price of China's products. Many countries from around the world have announced new tariffs that are going to be applied against a whole host of different Chinese products. And what that means is by the end of 2024, those products are going to be much more expensive in overseas markets. And that's likely to reduce the demand for those products. That's the whole point why these countries are introducing tariffs, because they believe that China is operating unfairly at the moment, that the Chinese authorities are subsidizing some of these Chinese businesses to enable them to sell their products at lower prices than domestic competition. So in order to offset that, you increase the tariffs, that raises the price and makes it more of a level playing field. So what we'll go through in today's video is the detail on those exports, and we'll talk about why I think we've seen a spike in that export figure, which is unlikely to be maintained for the rest of this year. We'll have a look at what's been happening with imports, because they're down year on year. And the reason that imports are important is because it tells us what's likely to happen over the next few months, because Chinese businesses import lots of raw materials, which they then use in their manufacturing process. So when you've got a fall in imports, it tells you that those companies are slowing down in terms of their productivity. So that's likely to lead to a fall off in the economy. We'll also have a look at what's been happening with inflation, because China has been struggling with deflation over the course of the last 12 months. And the reason that that's important is that it gives us a strong indication as to what's happening with Chinese demand, domestic demand. When you've got falling prices, it generally means that there's a fall in demand. People aren't spending as much, and so prices have to be cut to encourage them to spend. And that's bad news for the Chinese economy. We'll also have a look at what's happening with producer prices, the factory gate prices, because that's also a really good indicator as to what's likely to happen over the course of the next few months. And then finally today, I'll wrap up with my summary, talking about what I think is going to happen in the Chinese economy during the rest of 2024 and what this means for the global economy. But before we get started on all of that, I've got some really exciting news for you. I've decided to give away another one of my sculptures, and it's this piece, which is called Windswept Clock, because it's actually got a fully functioning clock built into it, and it's by a British artist called Paul Margetts, who I've got a lot of different pieces from, and I think this is absolutely fantastic. It's really heavy. This would look amazing in anybody's place, and you can win this by entering into the prize draw, and the tickets are priced at only £1 each, which is around $1.30. So if you want to support the channel, rather than buying me a coffee or sending me a YouTube super thanks, why don't you buy a ticket and you could win this thing, and you can follow on from the previous winners like Craig in Australia, who won the little red balloon dog, and Lars from the Netherlands, who won Stiltman. And there is a potential, if you do win, that you may have to pay some import duty. I don't think Craig or Lars did, so maybe you won't. And I'm getting an independent company to organise everything for me, so it's all above board. I won't be involved in drawing the winner. That's entirely at random. But if you'd like to win this, an original Joe Blog sculpture, you can't buy these things, you can only win them, then have a look at the details below and buy a ticket, and good luck. As I mentioned at the start of today's video, a lot of the countries that are buying huge volumes of goods from China have imposed additional tariffs during 2024, and the majority of those new tariffs are due to kick in the second half of the year. So this is one of the reasons why the figures really need to be looked into to see exactly what's going on with exports, and we'll come on to talk about that in a moment. But the two biggest markets for China's exports are the USA, which accounts for around 15% of all of its exports by value, and also the European Union, which accounts for a similar sort of figure. In May 2024, the US authorities announced that they were increasing the tariffs on some Chinese goods due to the fact that they believed that Chinese businesses were being subsidized by the state and therefore this didn't represent fair trade. China is the world's largest manufacturer of electric vehicles, and the USA has announced a tariff increase on Chinese vehicles from the original rate of 25% to 100%. So that's a quadrupling of the tariff. And the statement that's been published by the White House explaining why this has been done states, with extensive subsidies and non-market practices leading to substantial risks of overcapacity, China's exports of electric vehicles grew by 70% from 2022 to 2023, jeopardizing productive investments elsewhere. A 100% tariff rate on EVs will protect American manufacturers from China's unfair trade practices. In terms of steel and aluminium, the White House has said American workers continue to face unfair competition from China's non-market overcapacity in steel and aluminum, which are among the world's most carbon intensive. China's policies and subsidies for their domestic steel and aluminum industries mean high-quality, low-emissions US products are undercut by artificially low-priced Chinese alternatives produced with higher emissions. As a result of this, the tariff rate on certain steel and aluminum products will increase from 7.5% to 25%. In terms of batteries and battery components, the White House has said, despite rapid and recent progress in US onshoring, China currently controls over 80% of certain segments of the EV battery supply chain, particularly upstream nodes such as critical minerals mining, processing, and refining. Concentration in China leaves our supply chains vulnerable and our national security and clean energy goals at risk. In order to improve US and global resiliency in these supply chains, the USA has invested across the US battery supply chain to build a sufficient domestic industrial base. And in order to protect US industry, the tariff rate on lithium-ion EV batteries, lithium-ion non-EV batteries and battery parts will increase from 7.5% to 25%. In terms of solar cells, which are used in the solar power industry, the White House has said that China's policy-driven overcapacity depresses prices and inhibits the development of solar capacity outside of China. China has used unfair practices to dominate upwards of 80 to 90% of certain parts of the global solar supply chain and is trying to maintain that status quo. Chinese policies and non-market practices are flooding global markets with artificially cheap solar modules and panels, undermining investment in solar manufacturing outside of China. And as a result of this, the tariff rate on solar cells will increase from 25% to 50%. In terms of semiconductors, the White House has stated China's policies in the legacy semiconductor sector have led to growing market share and rapid capacity expansion that risks driving out investment by market-driven firms. Over the next 3 to 5 years, China is expected to account for almost half of new capacity coming online to manufacture certain legacy semiconductor wafers. During the pandemic, disruptions to the supply chain, including legacy chips, led to price spikes in a wide variety of products, including automobiles, consumer appliances, and medical devices, underscoring the risks of over-reliance on a few markets. Raising the tariff rate on semiconductors is an important initial step to promote the sustainability of investments in the USA, and as a result, the tariff rate on semiconductors is increasing from 25% to 50%. And interestingly included in the tariffs were ship-to-shore cranes. And the White House said, the administration continues to deliver for the American people by rebuilding the United States' industrial capacity to produce port cranes with trusted partners. Port cranes are essential pieces of infrastructure that enable the continuous movement and flow of critical goods to, from, and within the United States. And China's unfair trade practices have led to excessive concentration in this market. As a result of this, the USA is now increasing the tariff on Chinese ship-to-shore cranes from 0% to 25%. And this action is being taken to mitigate risks that could disrupt American supply chains. In terms of medical products, the tariff rates on syringes and needles will increase from 0% to 50%. For certain personal protective equipment, including respirators, face masks, and rubber gloves, the rate will increase from 7.5% to 25%. But it's not just the USA that are increasing tariffs against Chinese goods. The European Union recently completed a long investigation into electric vehicles being produced in China, and they deemed that their practices were unfair and that the authorities were subsidizing those businesses. And new tariffs have been announced ranging between 17.5% and almost 40%, depending on the different manufacturer. The EU asked for all of the manufacturers to cooperate in their investigation. Some of them did, and therefore they've received lower tariffs, and the ones that didn't have been hit with the higher tariffs. Turkey has also announced that it's applying a 40% tariff against vehicles being imported from China. But interestingly, and I think this is quite a cute thing, authorities have said that if China wants to move to Turkey and actually start producing cars in the country, so creating employment and also building their industry, then those tariffs will be waived. So this is basically an incentive for the Chinese to actually come over and build some factories. And alongside that, Indonesia have announced a 200% tariff against textiles that are being imported from China because they believe that China is flooding the market with low-cost textiles, which is damaging the existing businesses in Indonesia. And it's also reported that other countries such as Canada and India are considering similar sorts of tariffs. So China is facing a wave of increase of tariffs. And the reason for this is because many countries believe that the authorities in China are subsidizing Chinese businesses to enable them to sell products very cheaply all around the world. And as the USA have just identified, one of the risks in that is that it could put all of the competition out of business in all of those countries. And if you get to that situation, then obviously China could then start increasing prices because there wouldn't be anybody left to compete with them. This chart shows the percentage year-on-year movement in China's exports over the past 12 months. And the scale on the right-hand side of this chart goes from 10% positive at the top to 17% negative at the bottom. And what this shows is that in June 2023, exports were down by 12.4% year-on-year. The annual movement in exports remained in negative territory through to October, when they were down by 6.6%, and only returned to positive territory in November when they grew by 0.7%. There was a further increase in export trade over the next couple of months, and by January 24, the year-on-year movement was positive 8.2%. However, in February, that fell back down to 5.6%, and by March, the year-on-year movement was back in negative territory when exports fell by 7.5%. There was a bounce back in April when exports increased by 1.5%. In May, they increased by 7.6%. And the most recent figures for June 2024 show that the year-on-year movement in exports is up by 8.6%, which is actually the highest positive movement that China has seen for the past 15 months. So at face value, the June results look like really positive news for the Chinese economy, because exports, which are the heartbeat of the Chinese economy, have grown at their fastest rate for more than 15 months. So this potentially says that China is now on the up, things are going really well, and it will have a good finish to 2024. However, as with every other piece of data, you always have to dig into the detail to find out the full story. And in terms of what's happening right now with China's exports, the big increase that we've seen in June isn't being driven by a general increase in the global economy. We've got a very stagnant position right now in terms of what's happening. We're not seeing a huge surge in demand from all of the countries that are dealing with China. So that tells us that something else is driving this increase in exports. And as we've talked about in today's video, there has been a whole host of increases in tariffs announced by various countries that are going to be applied against Chinese goods over the course of the next 6 months or so. And the biggest of those, its biggest trading partner, is the USA, and those new tariffs come into effect on the 1st of August. So it makes sense for Chinese companies to try to front load their exports. If they can send some of their goods now before those new tariffs kick in, then they potentially may avoid them having to be applied against their products. And that's exactly what we're seeing right now. So the reason for the 8.6% increase in June isn't because there's been a general increase in demand. It's because Chinese companies are trying to send as many goods as possible now to beat the new tariffs. So in order to get a better understanding as to exactly what's going on in the Chinese economy right now, let's have a look at the level of imports for June. This chart shows the year-on-year percentage movement in the value of imports for China over the past 12 months. And the scale on the right hand side of this chart goes from 18% positive at the top to 15% negative at the bottom. And the reason that the movement in China's imports is important when assessing what's going on in the Chinese economy is that China imports a lot of raw materials, which it then uses in its manufacturing processes before exporting the finished goods. So the movements in the value of the imports tell us how much all of the companies in China are importing ahead of their expected sales. So it gives us forward visibility as to what's likely to happen in the Chinese economy over the course of the next 3 to 6 months. Because if Chinese companies are buying more raw materials, it means that they're gearing up, they're expanding, and therefore it's likely that the Chinese economy will also be growing. However, if imports are falling, then it indicates that companies are more cautious, they may be cutting back on the level of raw materials, and so we will see a slowdown in the Chinese economy. And what this chart shows is that 12 months ago, in June 23, the level of imports was down by 6.8%, and it remained in negative territory in the following 3 months, and by September 23, the year-on-year movement was down by 6.3%. And this ties into the figures that we've just seen for exports, which were also down in that period. There was a bounce back in October 23 when the level of imports increased to 2.9%. However, that was short-lived, and in November, imports fell by 0.7%. They grew by 0.2% in December. And in January, there was an increase in imports of 15.4%. And at that point in time, there was a lot of positivity about what was happening in China. However, unfortunately, that positivity proved to be short-lived. And in February, the year-on-year movement in imports was down by 8.2%. In March, it remained in negative territory at 1.9%. However, in April, there was another bounce back when imports increased by 8.4%. That increase reduced to 1.8% in May, and in June 24, the year-on-year movement was down by 2.3%. And if you take a step back and have a look at what's been happening over the last 12 months, you can see that in 7 out of the past 12 months, imports have fallen. And this tells us that the Chinese economy is struggling because companies are not increasing the amount of raw materials they're buying, and therefore they are not gearing up for growth. And if we specifically look at the trend over the past 3 months, there is a clear downward momentum here. The level of imports has been reducing and has now moved into negative territory. And this indicates that there are major question marks over the outlook for the rest of 2024. This chart shows the movement in the official rate of inflation in China over the past 12 months. What this shows is that in July 23, inflation was actually in negative territory, what's referred to as deflation. Prices were down by 0.3% year on year. And whilst that might sound like good news from a consumer's perspective, if you're buying things, obviously you want prices to go down because you'll have more money at the end of the month. It's really bad news from a company perspective because if you're making things, if you're bringing things to market, you generally work on the basis that prices will be rising, and therefore you can factor in increases in your raw materials and your labour costs and the costs of all of your factories and all of those sort of things. When prices are falling, either you have to negotiate lower prices with your suppliers and your workforce cut their wages, or you just take a cut in profit. And that's what's been happening in China over the past 12 months or so. And if we look at the figures, we can see that deflation was a major problem at the end of 2023, with prices falling by 0.2% in October, 0.5% in November, and 0.3% in December. Now in January, which was the month when there was a lot of positivity about the outlook for the Chinese economy for 2024, prices actually fell by 0.8%, which was the most that they'd fallen at any point during this period. Now, there was a bounce back in February. However, everything is relative. And if you have a look at the scale on the right-hand side of this chart, you can see that it only goes from 1% positive at the top to 1% negative at the bottom. Normally, when we're talking about inflation, we've got a scale that might go up to 10% or 15% or 300% if we're talking about Argentina. When we're talking about a movement from 1% positive to 1% negative, this is a very small movement in prices. So although it looks like there was a big bounce back in February, the increase in prices was only 0.7%. That fell down to 0.1% in March, rose to 0.3% in April and May, and in June 24 the annual movement in prices in China was 0.2%. And the reason that that's important is that if you're a company in China, unless your costs have risen by less than 0.2%, you will be making less profit today than you were this time 12 months ago, because prices simply haven't gone up, and it's extremely likely that your costs will have gone up. And one of the reasons why China is currently suffering from deflation is that consumers are not spending. There's not enough demand in the Chinese economy, so that isn't driving the economy. So China is now relying more on its exports than it is on its home market. And as we've just discussed, although the export numbers for June do look good at face value, when you dig into the detail, there is a key driver. Chinese companies have been front-loading those exports to avoid all of the increased tariffs, and therefore it's likely that we'll see a slump in exports at some point during the rest of 2024, because if all of their buyers have bought everything early, then they'll reduce the amount that they're purchasing later in the year. This chart shows the year-on-year movement in food prices in China, and if you follow the channel, you'll know that I always like to look at this metric because it gives us a good flavour as to what's happening on the streets. The poor people of any country always spend a much higher percentage of their income on food, so it's nice to see exactly what's happening. And what we can see here is that over the past 12 months, food prices have fallen in every single month. In July 23, the price of food was 1.7% lower than it was a year earlier. Over the following 6 months, food prices continued to fall, and by January 24, they were down year on year by 5.9%. Now, the level of price decreases has reduced over the past 5 months, but in June 24, the year-on-year movement in food prices was down by 2.1%. Now, obviously, this is good news from a consumer point of view. If you're buying food, it's great if the price of food is going down. But it isn't good news if you're in the food industry. If you're one of the many companies in China that's actually producing food, what you're seeing is your end price falling year on year. And as we've just discussed, unless all of their costs are going down proportionately, that means that those companies are making less profit. So that's putting pressure on them. Potentially, they may have to reduce their workforce. They may have to downsize. If they're making losses, they may need to cut their costs accordingly. So all of this is really bad news for the Chinese economy. It's good news in the short term for Chinese consumers that food prices are down. But for the food industry and the associated impact on the Chinese economy, it's really bad news. This chart shows the year-on-year movement of producer prices in China. And producer prices, also known as factory gate prices, are the price of goods as they're leaving the factories. And once again here, you can see that in every single one of the past 12 months, producer prices in China have fallen. In June 2023, the producer price index was down by 5.4%. The level of price falls did start to reduce, however by December 23, they were still falling by 2.7% year on year, and that trend has continued throughout 2024, and the figures for June show that year-on-year factory gate prices are down by 0.8%. A fall of 0.8% in factory gate prices in June 24 is bad news for China and the Chinese economy, because China fundamentally is a manufacturer. That's what it does. It makes lots of things and then exports those products to the rest of the world. So if factory gate prices are going down, that means that Chinese companies are earning less money because they're selling their products for less today than they were this time last year. Now, that might be okay if prices all around the world were going down. If we were in a deflationary global economy, so the price of raw materials was falling by more than 0.8%, then those Chinese companies could actually make more profit because their input prices would go down, and it wouldn't really matter if their output prices were also going down. But that isn't the situation at the moment. We've still got inflation all around the world. We're still struggling to bring it back under control in most economies. So the price of raw materials has actually been going up over the past 12 months. So Chinese companies are facing a situation where their input prices are rising rapidly in some situations, but their factory gate price is going down, and that will simply squeeze a lot of profit out of these businesses. But the bigger issue here from China's perspective is that it isn't just a single month that this has been happening for. It's happened in every single one of the last 13 months. So when you add up the cumulative impact of that, Chinese companies are under severe pressure right now because they're under pressure in terms of their input prices. They've also got pressure in terms of wages in China. And all of this is meaning that the Chinese companies are making less profit. And a lot of them have now moved into making losses. And that's obviously a serious problem because if you make losses for a prolonged period of time, and we've seen that factory gate prices are down year on year for more than 13 months, that starts putting pressure on your company, and at some point you may become illiquid, insolvent, and bankrupt. So what's the summary and conclusion today? Well, I wanted to post this video because the data that's being released officially by China is obviously really important. It gives us a good understanding as to what's happening in the Chinese economy. And it's always dangerous to just look at the headlines. You could pick up an article and it would say that exports in China are at a record-breaking level for the last 15 months. They increased by 8.6% in June. And you would go away from reading that headline thinking, well, China's doing really well. Joe Blogs is talking a lot of rubbish, as always. I get lots of comments from people saying that for every single video. But as I've been talking about in today's video, you always need to look into the detail. Have a look at all of the other indicators to get the balanced picture. And what we've talked about in today's video is that the exports are up in June. That is clear fact. There is no question about that. However, the reason that they're up is because there is a whole load of tariffs that are due to be applied against Chinese products over the course of the next few months. Those tariffs will make all of those goods more expensive in all of those markets, and it's two of the biggest markets. It's the USA and the European Union, so that's going to damage China if they start to see a fall off in sales. So in order to make sure that they beat those price increases, Chinese companies have been front-loading their exports. They've been sending lots of products to all of their overseas markets, and that's provided a short-term boom in exports. So the 8.6% that we've seen in June isn't because there's a general increase in global demand. We're not seeing economies recording record growth, GDP rising super fast. What we're seeing is Chinese businesses trying to beat the price hike. And what that will lead to is a fall in exports at some point over the next few months. Because as soon as those tariffs come in and all of those people have been buying the products, they won't need to keep replenishing that stock. And it's likely that as we move through the rest of 2024 and those price increases kick in, that there may actually be a reduction in demand for Chinese goods, which could mean that the fall off in exports is actually much greater than the proportionate movement in June. So we could see a real slowdown as a result of the actions of the overseas governments in Chinese performance. And as we've discussed many times before, China is entirely dependent on its exports. And what we saw from the imports data gives us an indication as to what's likely to happen over the next few months, because Chinese companies are importing raw materials which they use in their manufacturing process. And what we saw is that the figures for June are down year on year, and actually they've been down significantly over the course of the last 12 months. Chinese companies are struggling right now. And one of the reasons why they're struggling is because there's been a fall in domestic demand. And we've seen from the data that China is now sitting on the verge of deflation again. It's been struggling with its price increases over the past 12 months, and it looks like from the trend that it's likely to go back into negative territory before the end of 2024. And the reason for that is because consumers in China aren't spending. And that's double bad news from the Chinese companies' point of view, because their exports are likely to fall at the same time as demand is falling in the Chinese economy. And what we saw from the factory gate prices, the producer price index, is that that's been down consistently over the past 13 months. There have been year-on-year falls in factory gate prices. So that's putting a lot of pressure on those Chinese businesses, because if you're constantly having to cut your prices when they're leaving your factory and your input prices aren't also falling at the same rate, then it's going to cut out your profitability and potentially put you into a loss-making situation. And it's estimated that we could have around 40% of Chinese businesses currently making losses as a result of these consistently falling factory gate prices. So the overall summary of today's video is that exports in June were up by 8.6%, which was a great result for China. However, when you look at all of the other data, this looks like it's front loading. It looks like Chinese businesses have actually bulk sold a lot of their products to try to beat the price increases. That isn't a fundamental on which you can build the growth of your economy. And in fact, when you look at the fundamentals, factory gate prices are down, prices are now starting to move into negative territory in China, and it's likely through the rest of 2024 that China is going to face difficulties. And there's a major question mark as to whether or not it will hit its 5% growth in GDP for 2024. So all of this is really bad news for the Chinese economy. But unfortunately, it's also likely to be bad news for the global economy because China is the second largest economy in the world by some way. It's smaller than the USA, but it is significantly bigger than all of the European countries. And if China starts to reduce, that means that it will buy less raw materials from all of the rest of the world, and therefore they will sell less. That will slow down those economies, and the knock-on impact of China slowing down would be that we would see a slowdown in other economies too. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.